Welcome to our exciting exploration of investment wisdom. Today we're diving into the Warren Buffett philosophy of investment, how a combination of value investing and smart acquisitions drives extraordinary success, by Elena Chirkova. Get ready to uncover the secrets behind Buffett's remarkable success in the world of finance. If you enjoy our insights, don't forget to give us a thumbs up and subscribe for more engaging content. Now let's jump right into the book. In this introduction, we explore the chapter titled, Who is Warren Buffett?, which delves into the life and investment philosophy of Warren Buffett. The chapter begins by highlighting Buffett's early fascination with money, indicating that his thoughts on financial success began in childhood. It discusses his ambitions and the influence of Benjamin Graham, a key figure in his investment approach. The narrative then transitions to Buffett's rise in the investment world, emphasizing the remarkable performance of Berkshire Hathaway. Finally, it raises the intriguing question of whether Buffett's success stems from skill or mere luck, setting the stage for deeper exploration in the following slides. This slide focuses on Warren Buffett's early life and career, illustrating how his childhood aspirations shaped his future. From a young age, Buffett expressed a desire to become a millionaire, which he pursued through various entrepreneurial ventures, including delivering newspapers. The founding of Buffett Partnership in 1956 marked a significant milestone in his career, showcasing his early investment acumen. The slide also highlights the impact of his father's death, which reinforced Buffett's commitment to financial independence. Notably, his early investment returns set the foundation for his later success, emphasizing the importance of self-reliance in his journey. We delve into Warren Buffett's investment philosophy and the remarkable performance of Berkshire Hathaway. Buffett's long-term investment strategy has proven effective, as evidenced by the impressive growth of the company's asset book value. The section of the book compares Buffett's returns to the market index, highlighting his consistent outperformance. It also addresses the ongoing debate regarding the rationality of financial markets, with Buffett famously rejecting market price analysis in favor of a more fundamental approach. This discussion underscores the significance of his investment methodology, which has contributed to his legendary status in the investment world. In this chapter, we explore the profound influence of two legendary investors, Benjamin Graham and Philip Fisher, on Warren Buffett's investment philosophy. Buffett acknowledges that his success is significantly attributed to the teachings of these two mentors. Graham's seminal work, Text It, The Intelligent Investor. This section delves into Benjamin Graham's investment philosophy, which has had a lasting impact on the field of value investing. Graham's approach is characterized by a focus on the intrinsic value of stocks, which he believes should be assessed based on the company's fundamentals, rather than market trends. The concept of a margin of safety is particularly crucial, as it provides a buffer against potential losses. Graham's teachings not only shaped Buffett's investment strategies, but also laid the groundwork for generations of investors who seek to make informed, rational decisions in the stock market. In this part of the chapter, we examine Philip Fisher's approach to growth investing, which has also influenced Warren Buffett's strategies. Fisher's focus on high-quality companies with strong growth potential offers a different perspective compared to Graham's value-centric approach. He believed that investing in well-managed companies could lead to substantial returns over time, emphasizing the importance of evaluating a company's management and long-term prospects. Fisher's principles encourage investors to adopt a long-term view, which aligns with Buffett's philosophy of holding investments indefinitely for maximum growth. In this slide, we introduce the chapter titled, What Kind of Business Does Warren Buffett Like? The focus is on the qualitative decisions that Buffett emphasizes in his investment strategy. The slide outlines the characteristics of businesses that Buffett finds unattractive, particularly those that operate in commodity markets where competition is fierce. It highlights the issues of overcapacity and poor fundamentals, using textiles and insurance as examples. The overarching theme is Buffett's preference for businesses with strong fundamentals, which is crucial for long-term investment success. This slide delves deeper into the characteristics of businesses that Warren Buffett considers problematic. It emphasizes the need for businesses to avoid situations where they must continuously invest capital at low returns. The slide discusses how excess capacity in industries leads to price wars, ultimately harming profitability. Historical examples from Buffett's own experiences with Berkshire's textile and insurance ventures illustrate these points. Additionally, it highlights Buffett's belief that management can only do so much in industries with poor fundamentals, stressing the importance of product differentiation for achieving success. In this slide, we explore the characteristics of businesses that Warren Buffett finds ideal for investment. Buffett looks for companies that can effectively employ capital at high returns over the long term. He emphasizes the importance of simplicity and predictability in business operations, which allows for better investment decisions. The slide also highlights Buffett's long-term investment horizon, which is crucial for weathering market fluctuations. Additionally, it discusses the significance of having an independent opinion to avoid following market trends blindly, and the preference for businesses that possess economic franchises and strong management teams. In this introduction, we set the stage for a detailed comparison of Warren Buffett's investment strategies with those of Robert Merton and Peter Lynch. The chapter highlights Buffett's unique approach to investing, emphasizing the importance of understanding risk and market behavior. We will explore how Merton's efficient market hypothesis contrasts with Buffett's philosophy, as well as how Lynch's strategies align closely with Buffett's principles. The discussion will also touch upon the infamous collapse of LTCM, illustrating the consequences of misjudging risk in investment practices. This frame delves into the contrasting philosophies of Warren Buffett and Robert Merton. Buffett emphasizes the significance of self-discipline and personal judgment in investing, while Merton's approach is rooted in complex statistical models. The chapter discusses how LTCM's reliance on these models ultimately contributed to its collapse, highlighting Buffett's skepticism towards mathematical predictions. The historical context of Merton's influence on Wall Street is also explored, illustrating how his theories shaped investment practices during the late 20th century. This comparison underscores the importance of understanding risk beyond mere numbers. In this section, we compare Warren Buffett's investment strategies with those of Peter Lynch. Both investors prioritize company fundamentals, but their approaches differ in execution. Lynch's success with the Magellan Fund is highlighted, showcasing his ability to deliver high returns. Buffett's long-term investment philosophy contrasts with Lynch's more active management style. The frame emphasizes the importance of understanding market cycles and the shared belief in acquiring undervalued companies. This comparison illustrates how both investors, despite their differences, align on key principles of successful investing. This slide introduces the chapter titled, An Excursion Through Financial Theory and Corporate Finance with Warren Buffett. It highlights key themes such as the educational role of Berkshire Hathaway and the contrasting views on market efficiency and investor behavior. Buffett's insights into market irrationality and the metaphor of Mr. Market illustrate how emotions can influence investment decisions. The slide also emphasizes the importance of understanding risk, which Buffett defines differently than traditional finance, focusing on the investor's knowledge and competence rather than mere volatility. This sets the stage for a deeper exploration of Buffett's investment philosophy. In this slide, we delve into Buffett's investment philosophy, particularly his views on market efficiency and rationality. Buffett argues that while markets can be efficient, they are not always rational, leading to mispriced assets. The slide discusses how herd behavior can lead investors astray and emphasizes Buffett's critique of traditional risk assessment, which often focuses on volatility rather than true risk. By advocating for long-term investment strategies and informed decision-making, Buffett encourages investors to avoid unnecessary risks and to prioritize patience and predictability in their investment approaches. This philosophy is central to understanding his success. This slide focuses on Buffett's approach to corporate governance and how he incentivizes managers within Berkshire Hathaway. By encouraging managers to act as if they own the business, Buffett fosters a sense of responsibility and long-term thinking. The slide highlights his preference for simple compensation structures that do not rely on stock options, which can misalign interests. Instead, Buffett emphasizes long-term performance and the importance of dividends and capital allocation. Transparency and accountability are also key themes, as Buffett believes that clear communication and responsible management lead to better outcomes for shareholders. This governance model is integral to Berkshire's success. In this introduction, we explore the chapter titled, The Use of Debt by Berkshire Hathaway. The chapter delves into Warren Buffett's perspective on debt and leverage, emphasizing the importance of financial stability. It discusses how high levels of leverage can lead to increased bankruptcy risks, particularly in the context of the leveraged buyout, LBO boom of the 1980s. Buffett's critical stance on excessive borrowing is highlighted, along with the significance of EBITDA as a measure of a company's ability to manage debt. The chapter also provides a historical overview of junk bonds and their associated risks, setting the stage for a deeper understanding of Berkshire Hathaway's financial strategies. This section discusses Buffett's approach to debt and leverage, emphasizing his belief that debt should be viewed as a tool for refinancing rather than repayment. The chapter outlines the dangers associated with high leverage, including the increased risk of bankruptcy and the strain on cash flow due to interest payments. Buffett's preference for companies that maintain low levels of debt is highlighted, as he believes that free cash flow is essential for sustainable growth and investment. Additionally, the chapter touches on agency problems, illustrating how excessive debt can lead to inefficient management decisions, further complicating the financial landscape for companies. In this part of the chapter, we examine the critical role of insurance in Berkshire Hathaway's overall strategy. Buffett views the insurance business as a vital source of capital, leveraging the concept of float to enhance profitability. The chapter discusses how Berkshire strategically times its entry into the insurance market, capitalizing on opportunities that arise after catastrophic events. Underwriting discipline is emphasized as a key factor in maintaining profitability, with Buffett's unique approach to risk management setting Berkshire apart from competitors. The relationship between insurance operations and borrowing costs is also explored, illustrating how effective management of insurance can lead to lower capital costs for the company. In this introduction, we set the stage for discussing Warren Buffett's early acquisitions, emphasizing the shift from theoretical analysis to practical application. The chapter highlights Buffett's unique approach to acquisitions, showcasing his psychological insights and personal branding. We will explore how these elements contributed to his success in various transactions, particularly focusing on the Nebraska Furniture Mart acquisition. This chapter serves as a foundation for understanding Buffett's strategic mindset and the principles that guided his investment decisions in the early stages of his career. This slide delves into the specifics of the Nebraska Furniture Mart acquisition, a pivotal moment in Buffett's early investment career. The purchase price of $55 million is notable, especially considering the strong performance of the business under Mrs. B's leadership. Her unique approach to maintaining low costs while achieving high sales volume exemplifies a successful business model. Buffett's trust in Blumkin played a crucial role in the swift transaction, highlighting his ability to assess character and integrity in business dealings. The subsequent profitability of NFM underscores the effectiveness of Buffett's strategic insights. In this section, we explore two additional acquisitions, Borsheim's and Scott Fetzer. The purchase of Borsheim's illustrates Buffett's focus on financial synergies and the enhancement of his personal brand. Although the financial terms remain undisclosed, the store's operational efficiency contributed to its success. The acquisition of Scott Fetzer showcases Buffett's tactical approach, entering the bidding process after other attempts had faltered. This strategic positioning allowed him to acquire the company at a favorable valuation, emphasizing his keen understanding of market dynamics and the importance of timing in investment decisions. In this introduction, we explore the chapter titled, Who is the Fairest of Them All? The Role of Image in Buffett's Investment Strategy. The chapter delves into Warren Buffett's distinctive investment philosophy, emphasizing his preference for acquiring entire companies rather than merely trading stocks. Buffett's early successes in the investment world helped him build a strong reputation, making him a sought-after buyer. Sellers often choose Buffett due to his non-intrusive management style, which fosters trust and integrity. Notably, Buffett's approach frequently involves minimal due diligence, showcasing his confidence in his investment choices. This section highlights Buffett's acquisition philosophy, which is characterized by a non-hostile approach. He prioritizes retaining existing management, recognizing the value of their experience and emotional ties to the company. This emotional connection often influences sellers' decisions to sell to Buffett, even at lower prices. His tendency to avoid extensive due diligence reflects a deep trust in the integrity of the sellers. This hands-off strategy allows for successful acquisitions with minimal interference, creating a virtuous cycle that attracts more quality investment opportunities. In this part of the chapter, we examine the significance of trust and image in Buffett's investment strategy. His reputation as a trustworthy investor plays a crucial role in attracting sellers. By offering genuine compliments and showing respect, Buffett fosters strong relationships that enhance business negotiations. Personal connections are vital, as they create a sense of loyalty among managers who appreciate Buffett's non-interference approach. This positive image not only attracts quality companies for acquisition, but also leads to long-term partnerships that contribute to Buffett's ongoing success in the investment world. This introduction slide presents the chapter title, Buffett as a Strategic and Portfolio Investor, which encapsulates the essence of Warren Buffett's investment strategies. The chapter delves into how Buffett differentiates himself from traditional investors by focusing on emotional connections with business owners and the long-term sustainability of the companies he acquires. It highlights the importance of understanding the motivations behind business sales and how Buffett's approach often leads to mutually beneficial outcomes. The following slides will explore these themes in greater detail, including specific case studies and the implications of Buffett's strategies on the investment landscape. This slide discusses the key differences between strategic and financial investors, emphasizing how Buffett's approach uniquely blends both strategies. Strategic investors often seek synergies that can enhance their existing operations, while financial investors focus on quick returns through improvements and eventual resale. Buffett, however, positions himself as a long-term owner who respects the emotional ties of business founders to their companies. The case of Fechheimer serves as a prime example of how Buffett's neutrality and commitment to preserving company culture make him an attractive buyer for many business owners. This understanding of emotional connections is crucial in Buffett's investment philosophy. In this slide, we explore Buffett's acquisition strategies, which are characterized by a focus on long-term ownership and stability. Buffett often utilizes Berkshire shares in transactions to provide tax advantages for sellers, making his offers more appealing. Notable acquisitions like Dairy Queen and Star Furniture highlight his ability to create mutually beneficial arrangements. Buffett's reputation as a white knight investor allows him to step in during times of distress, providing companies with the stability they need. Additionally, the liquidity of Berkshire shares and the prevailing market conditions play a significant role in shaping his investment decisions, ultimately influencing the management and direction of the acquired companies. In this introduction, we explore the chapter titled, Reputation at Work. The chapter discusses Warren Buffett's evolving investment philosophy, particularly his changing views on acquiring companies in turnaround situations. Initially, Buffett avoided such companies, believing they seldom succeeded. However, he later recognized the potential in excellent companies that were misappraised due to unusual circumstances. The chapter highlights notable acquisitions, including Johns Manville, Fruit of the Loom, and Benjamin Moore, showcasing Buffett's strategies and techniques in navigating the market, especially during times of economic downturn. This slide delves into the case study of Fruit of the Loom, which was acquired by William Farley in 1985 for a substantial sum through a leveraged buyout. The financing structure involved significant debt, raising concerns among analysts about the company's ability to service it. Farley's ambitious projections for operating earnings proved to be overly optimistic, and he faced challenges in managing a larger enterprise. The company struggled with debt and operational issues, leading to its eventual bankruptcy filing in 1999. This case illustrates the complexities and risks associated with leveraged buyouts and financial management. In this section, we explore Warren Buffett's acquisition strategies, which are characterized by a focus on cash offers and the ability to act quickly. Buffett targets companies with strong brands and capable management, often recognizing opportunities in distressed firms. His approach includes leveraging financial synergies to enhance the value of acquisitions. Notable successes include the acquisitions of Benjamin Moore and Johns Manville, which exemplify his strategy of seeking long-term growth and stability. Buffett's methods highlight the importance of thorough analysis and strategic timing in the investment landscape. This introduction highlights the key themes of the chapter, focusing on Warren Buffett's early life and the development of his investment acumen. It emphasizes how Buffett's interest in finance began at a very young age, showcasing his dedication to learning about the stock market. The mention of his first investment at age 11 illustrates his proactive approach to investing. The slide sets the stage for a deeper exploration of Buffett's intelligence and analytical skills, which are crucial to understanding his success in the investment world. This slide delves into Buffett's early investments and the influences that shaped his investment philosophy. It recounts his first investment in Citi Service shares, illustrating his early hands-on experience in the market. The purchase of a farm at age 15 showcases his entrepreneurial spirit. The slide also highlights the importance of Buffett's education at Columbia University, where he learned from the best. Furthermore, it introduces Charlie Munger, whose partnership with Buffett has been instrumental in refining his investment strategies, emphasizing the collaborative nature of their success. This slide focuses on the significance of social connections in Warren Buffett's investment success. It emphasizes how his relationships with influential figures in business and politics have opened doors for investment opportunities. The mention of Katharine Graham illustrates how high-profile connections can enhance one's network. Additionally, the informal club Buffett created for discussions on investments highlights the collaborative aspect of his approach. The slide concludes by noting how Buffett's humble demeanor, combined with his influential connections, has allowed him to navigate challenges effectively in the corporate world. In this frame, we introduce the chapter conclusion, highlighting the key points of Buffett's early career. Buffett started in the 1950s, following Graham's investment principles during a time when the market was recovering from a significant crisis. His career began amidst a long bull market, which provided a favorable environment for investment. The organizational structure he adopted, transitioning from mutual funds to a joint stock company, played a crucial role in his ability to outperform competitors. This shift allowed him to capitalize on opportunities that mutual fund managers could not, leading to better long-term returns. This frame delves into Buffett's unique investment strategy, emphasizing how he leveraged the insurance business to secure long-term capital at a lower cost than traditional investments. The structure of Berkshire Hathaway allowed for the concealment of additional funds, enhancing its financial position. Buffett's reputation for loyalty to managers attracted favorable deals, as many business owners preferred to work with him over less amicable investors. His friendly approach in acquisitions further solidified his standing in the business community, allowing him to secure valuable minority stakes without the intention of hostile takeovers. In this frame, we explore the future of Berkshire Hathaway and the potential impact of Buffett's eventual retirement. By the 1980s, the financial landscape had become more competitive, yet Buffett's reputation as a trustworthy investor continued to grow. His unique corporate culture attracted many private company owners looking to sell. However, as Buffett ages, questions arise about the sustainability of Berkshire's culture and reputation without his leadership. Will Buffett's brand endure after he steps down? The uncertainty surrounding the legacy of his management style and its influence on future leadership remains a topic of discussion among investors and analysts alike.